tell me when they can talk.
All right, hey guys, what's going on? We are here for the Federal Reserve announcement. I'm joined by Dr. B right here. My name is Gareth Soloway here at Verified Investing Studios, live for the coverage of the Federal Reserve announcement and the press conference. We're going to get it right into the charts, so you guys are not going to miss anything that goes on. We'll be watching to see what is said. We'll be bringing that to you live, as well as live technical analysis. So let's rock and roll.
You bet, yeah, let's do it.
All right, so let's jump over here, guys. So the first things first, right? S&P 500, what's going on today? Look at this. This is the 10-minute chart. 10-minute chart is literally not doing much.
No.
It is just waiting for this Federal Reserve decision. Now, let's be clear. The Fed is not going to be raising rates, and they're not going to be cutting rates. It's all about what their guidance is for future cuts. So, again, is it one cut? Is it 0 cuts? Is it 2 cuts? What is it going to be? Maybe even they're going to talk rate hike, although I highly doubt it. Now, I think today the biggest things to look at, you want to look at the 10-year yield. I continue to think that there's limited upside on the 10-year yield. This is the 10-year yield daily chart. We see right here, this is your max upside. Every time it hits here, it pulls back. Over here, we had a bigger pullback right down here. So in general, yeah, you could go up a little bit, but I'm still in the camp that eventually we go down. Notice how that's anti or opposite of what the media is saying. Everyone's now talking about higher rates. You flip on CNBC, it's all about higher rates. I tend to think that the chart, and I listen to the chart is telling me maybe a little higher, but ultimately downside is coming. So that's going to be something we're going to watch here as well. The U.S. dollar. The dollar, again, if we flip over to the U.S. dollar chart, we know we had the breakout, the retrace to the scene of the crime. I want to zoom in on this even more, right? So again, breakout, retrace to the scene of the crime, break up, bullish consolidation. If there's upside, you're going to be limited to about 107, and then I think you start pulling back on the U.S. dollar as well. All right, Dr. B, what are you thinking here?
Yeah, you know, a lot of great points. So just to talk about the spiders first here, right? So I'll pull it up on my charts. You can see this red line is the 50-day moving average. And so what I've talked about a lot in the live day trading room is that when we're above this 50-day moving average, the trend is up. And when we're below, the trend is typically down, right? If you look on the hourly chart, for example, in the S&P, you'll see a lot of lower highs and lower lows. That in general is telling me that we're in a downtrend on the S&P. And I know today is the Fed decision day. We're going to be focusing on interest rates. But in terms of what that means for the markets and in general, the way that the markets are going right now, I see a downtrend in the S&P, and I expect this actually to continue. You can see that we've broken down here on the S&P from the 50, and now we've retraced to the scene of the crime and are getting pounded back down. And honestly, this price action right here is really a bear flag. So if the Federal Reserve acts hawkish today, I think we break down out of this bear flag, and I have a level around 450 on the S&P as a target for me. Right now I'm short the S&P and several other other stocks, including the SMH. You saw a lot of pressure on the semis after AMD earnings. You know, SMCI has gotten hit, NVIDIA, AMD. And so we often talk about when the semis are strong, there's really not much to worry about in the markets. And now the semis are weak and they are in a downtrend.
Yeah, and it's been pretty remarkable, guys. So the semis have really been crushed here, and we saw SMCI earnings coming out. That stock was getting crushed and is getting crushed. We've seen NVIDIA being crushed as well. In fact, let me see if I have SMCI's chart here. And this is really a cool thing, because here's my channel on this, and basically what I'm saying is this channel has worked. And what the key to technical analysis is that you use the levels until proven otherwise, right? So as long as it's working, I keep it so simple. All right, well, every time it hits here, it goes up here, and then when it comes down here, it goes up there. And so the idea is that eventually you head down here, which is around the $600 level. So we'll watch that. By the way, we have about 3 minutes until this announcement comes out. We'll take it live to you guys, or I'll give you and cue you guys in on that. And then when we go to NVIDIA's chart here, if we just go quickly to this one's still holding up. I mean, it's still best of breed. There's no doubt about it. But again, you could argue that you basically were rejected. If you take this high and you just draw that trend line down, you basically got rejected. Down right into it, and now you're getting rejected again. The question is, again, do you kind of go, and it almost looks like this could be a parallel as well to that upper line. Do you kind of come down to this zone as well? So By the way, Qualcomm after the bell on earnings, that's another chip stock. I was just going over this. By the way, I'm not short or long Qualcomm, but I will say this is that this chart is not a pretty chart, Dr. B, and I think you'd agree with me on this, is that you have this very distinctive trend line here. We broke below. There's your retrace to the scene of the crime. And again, you know, if Qualcomm does not perform after the bell on earnings, then chips are going to get hit again tomorrow. So much fear, so much overbought market, you know, action, chart action that has to be worked off. This is very, very tricky. So, again, turning back to the Fed,
So,
what do you think?
So this is the Fed funds rate. So this is what we're looking at today, right? Is this rate going to be increased or decreased or, you know, stay the same? So we're currently at 5.33%. If you look right here, we're essentially at the same level that we were before the Great Recession, right? So this is pretty interesting. And so, you know, we'll talk about this a little later, but we do have an inverted yield curve. And when the yield curve de-inverts, that's typically when we see a recession that's coming. That's predicted the 7 last recessions. So pretty interesting. We should be just about, what, a couple minutes away now.
Yep,
for the
a couple
Fed
minutes
funds.
away, absolutely, absolutely. And again, we'll see again if we get the data here coming through. I know this is the Fed Child gives updates, so this is going to be his speech, which will be at 2:30, and then I'll keep an eye on the charts here until we get into that. But I'll bring you guys the Fed decision, which is again imminent. And as soon as I have it, I will let you guys know. And really what we're going to do is we're going to watch. Let's watch the dollar. You want to put up the yield, the 10-year yield, and then we're going to go to gold too, and we'll flip back and forth through our charts and really watch to see. Now, again, I'll also go over levels on an intraday basis, but I'm a little bit more nervous. Last time we did this, folks, I did a trade. I don't think I'm going to trade this one because I'm just not sure about the levels that we're going to see. Spiders, again, are kind of hovering here on an intraday basis. If you just took this pattern, what type of pattern is that? That's a bear flag. But again, Fed decisions are tricky. So again, we'll take it from there and kind of see where we go. But I'm going to throw up the dollar. Let's look at the U.S. dollar on the 10-minute chart. Again, 10-minute chart on the U.S. dollar is getting ready for this move here, and we should be out here. I'm seeing time-wise, looks like about 2 minutes to go. We're just under.
Yeah, in the meantime, I'm just going to pull up the U.S. inflation rate year over year. You can see here that it's about 3.5%. Right here in 2022, it got up to over 8%, and you can see the high inflation here back in the 80s. And this is actually even back to the Great Depression. Look at all this whipsaw pattern. But really, this is the goal for the Fed right here around 2%, and we're still at 3%. That is causing pressure on the Fed. The Fed thought, and many people thought, the inflation rate would continue lower, but it actually stopped right here around, what, about 3% even, and then started to inch back up. And that's putting a lot of pressure on the Federal Reserve to decide, you know, what to do with interest rates.
And I think part of that, too, is that the inflation, guys, is when you have the stock market hitting new all-time highs, the crypto market's all-time highs, commodities going up, it's a recipe for inflation. So the Fed needs to get the stock market down, needs to get commodities down, and then you can actually see inflation starting to fall again. But until that happens, it's going to be tough for inflation to come under wraps. And unfortunately, they may have to trigger a recession to get us there. And no one wants to see that. The biggest question I have is if they trigger it, can they get us out without massive printing of money? And I think that's going to be the harder thing to do. All right, guys, again, we should be just seconds away here from the Fed decision. And again, expected is no change in interest rate policy, but we're going to find out what their commentary is. And I will do my best to guide you guys to this, and then we'll bring the press conference to you as well, which is oftentimes more important. The press conference being more important as, Jerome Powell usually gives some color to his analysis. All right, let's keep an eye. Here we go, guys. Dollar's inching up. We can see the dollar right here starting to inch down a little bit. So far, no major movement. A little bit more downside starting here. Oh, here we go. That actually should be slightly, maybe, again, dollar weakness is showing that there's a slight dovish angle to it if we see a big drop in the dollar, but so far it's going back up. So far this would be considered no move. Like this is basically non-event right here. All right, keeping an eye on it. Gonna zoom in a little bit. Let me flip over to the 10-year real quick here on the 10-minute chart. Same thing, up a little initially, now starting to come in. All right, here we go.
5.5%. It does note a lack of further progress on inflation in recent months. The prior statement had noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had said before we're moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect to cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff to 25 billion from 60 billion. Pretty aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff that had been going at 720 billion a year of treasuries, by the way, down to 300. It left the runoff of mortgage-backed securities the same at 35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve continues to say the economy is increasing at a solid pace. It says job gains have remained strong. Repeats that inflation has eased, but again, noted that progress has stalled. And I'm going to repeat some statements that they repeated this time around, but maybe now they're perhaps more important. It said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation risk, and they're prepared to adjust policy as appropriate if risks emerge. Those have been in the statement.
All right, so basically no change in interest rate policy, guys. Essentially, it looks like they're capping their runoff quantitative tightening. They're lowering that bar, essentially, so they're slowly moving towards stopping quantitative tightening. Remember, quantitative tightening is them dumping their balance sheet. One of my biggest gripes with the Fed is that every time we have a crisis, they jack their balance sheet up by trillions of dollars, and then they reduce it by 10% in the good times, and then they jack it up another trillion, multiple trillions of dollars. And so there's just no getting out of this, just like the U.S. government debt, unfortunately. All right, what do you got, Dr. B?
Yeah, I'm just taking a look at the S&P 1-minute chart just so we can see a little more granular detail as to what's going on. And honestly, there's not much price action here at all. Initially a pop up, then a pop down, but essentially, I don't expect any big moves out of this. You mentioned government debt, and let's put it up here, U.S. debt, okay? No, that's credit card debt. Let's take a look at government debt. $34.5 trillion. And, this is part of the issue, that the U.S. is essentially addicted to debt, and it just keeps going up. And I looked back here along this chart. I don't see anywhere where we've had a drop. It's just trades, go sideways.
Yeah.
And so that's the issue, is there are very few politicians who are going to want to stay in office and try to cut debt over time, because
they got to be reelected,
yeah,
right?
Exactly.
Yeah, and one thing I want to show you on this is a great chart, guys, and a couple things to recognize. So number one, this year alone, there's $7 trillion in debt that has to be essentially refinanced by the government. The problem is where our interest rates. Our interest rates used to be, what, 1%, So again, 1%, but now we're talking at what, 4 to 5% rates. That's on a $7 trillion. That is massive,
huge.
Massive additional interest payments. There's a reason why they're saying interest payments are going to be $1 trillion a year now alone. That's insane. In addition, generally the way the government and the history has worked, and this is the way governments are supposed to work, is that during growth periods, when revenue from the economy doing great is higher, you pay down the debt. So, it goes up during like 99, 2000, the dot-com collapse, it went up, and then it's supposed to, when we had a good run between, 2000 and whatever to 2007, it was supposed to go down, and it didn't. And same thing going forward is, since 2009, we've had an amazing run in the economy. I mean, we went through COVID, I understand, but for the most part, all it's done is go more and more vertical. And that is not good, because essentially, what if we do hit a recession? How are they going to, if anything, this is just going to go like this. And that's the scary thing about it.
Just keep printing money, devaluing the dollar, increasing inflation over time.
That's true. So let's jump back over here, guys. I want to show you real quick. So looking at the dollar, we are seeing a dip in the U.S. dollar here. It's not a massive dip, but we are seeing a little bit of a dip. In general, that implies that the markets are breathing a small sigh of relief from the Fed statement. Now, granted, we still have the press conference coming up at 2:30, which we'll get to in just a little bit. But right now, again, that's something that I'm taking note of. If we look at the 10-year yield, it is also dropping. So if yields are coming down, what does that tell us? Think about it logically. It tells us that maybe the markets are saying the Fed doesn't have to raise interest rates quite as aggressively, or maybe they can even lower a little bit more than they initially, than the markets initially, thought. Now, granted, it's such a small move, it really doesn't move the needle too much, but that's just something to keep in mind there. And then I think we do want to go to Bitcoin. We got to check in on Bitcoin, which is actually having a good bounce here, guys. Good bounce on Bitcoin. Bitcoin again today got rocked to the downside, but again, you can see since this Fed announcement, we're starting to curl up just a little bit. Although look at this, on a 10-minute chart, see this high pivot? Look at where it stopped right here. So you just see again, and basically what you're creating is a sideways channel, right? A sideways down, and then you're chopping here. So if you're a bull, you need Bitcoin to get over here and start to break up significantly. If you're a bear, you want it to come down here and then break here, and then it should have a significant decline on that front. Let's go to gold real quick, see what we got on gold. Gold, again, a little bit of an intraday pop, not much yet. So again, somewhat of a muted response across the board, but we still have the press conference. But you can see, again, gold kind of down ticked and now starting to push up just a little bit. Flipping to that daily chart, what do we have there? Just a small bounce, right? Daily chart, you can see a small green candle compared to yesterday's big drop. What do you got over here?
Yeah, so I'm looking at a lot of government statistics today and economic statistics. If you look at the unemployment rate, right? This is a chart that goes back to the 40s or 50s, and the average unemployment rate over that time period is around just under 6%, right? 5.7%. We're currently at 3.8%. And yes, while we don't want to see, people unemployed, unfortunately, what I'm reading, the more I read, is that because wage growth is so strong, unemployment will likely have to tick up in order to bring down inflation, right? And so you can see the unemployment rate spike here in the 80s, right, during high inflation. You can see it spike here during the Great Recession, and then also during COVID, okay? But the unemployment rate has dropped dramatically, and now we're hovering here in the high threes. I do think that we have to see a move up maybe to this 5, 6, 7% range for unemployment. What are you looking at here?
So right here, guys, what we have is this is the U6, and this is something I'll be watching on Friday's non-farm payrolls report really closely. This is the stuff that the mainstream media glosses over. They don't tell you very much about it. What this shows us is the U6 unemployment rate. Now, U6, to break this down, is people that are underemployed. So if you're at a job and you're working full-time, your boss may come to you and say, hey, listen, we can't keep you on it full-time, but we'll give you part-time. Well, you don't want part-time, but that's your only option, so you stick with part-time. All right, technically, you're not considered unemployed because you're part-time. Same thing if you're looking for a job and you're like, oh, man, I can't find any full-time work, so I'll take 2 part-time jobs or 1 part-time job. You're technically not being fully employed as a full-time worker, but you're partially employed. So this is what this showed us here. So basically what we can see is that since December of 2022, and I'm going to change the color here so you guys can see this, since 2022, the U6 unemployment rate, so people that are underemployed, has consistently been going up. This is a precursor. Every recession we have had, maybe except for COVID, which was kind of like a freak black swan event, but every recession you've seen an uptick in this U6 unemployment before a recession. So just something to keep in eye on there. I'll be watching this number. Does it increase? I think in March it was right around 7.3%. I'm curious if we come in at 7.3.5 or 7.4 on Friday.
Yeah, so take a look at, again, more economic data, right, from the Bureau of Economic Analysis. We have U.S. personal savings rates, okay? This is a monthly chart. This goes back to the 50s. And you can see the general trend here. I'd say that the personal savings is about 10, right? This might be a percentage, I'm not sure. But currently we're at 3.6. All right, in general, the average area is right around here at 10. So you've got a couple things here. You have to put all of this together. So you've got personal savings rates at some of the lowest points in recent history. You have unemployment rates at some of the lowest points in recent history. And you have credit card debt at some of the highest points, the highest point in history, right? So if you put all of this together, if unemployment starts to tick up, okay, what's going to happen? People don't have as much money saved. They have high credit card debt. They're going to pull back on spending, and that will probably bring down CPI and inflation, right? And I think that's the only way I can see this playing out.
And that's what, unfortunately, that's what the Fed is going to have to do, guys. Again, so just to really understand what's going on here is that the Fed made the mistake of allowing this, and you might say, did they allow it? But they honestly did, because they were flooding the market with liquidity. Even with high interest rates, they were pumping reverse repo funds back into the banks, which then the banks were lending it out. That was more liquidity going out to people. We saw the emergency bank lending program from a year ago in March. That was when those banks were failing. That was a freebie for the banks. And so all this money kind of got into the system, and it helped these asset prices, including crypto and stocks, go to all-time highs. And then commodities, same thing.
Yeah.
And there's no way, when you have gains like we've seen in the stock market and crypto, and people are looking at their 401ks, their IRAs, they feel richer, and they're more likely to say, you know what, let's go out to dinner tonight. Let's go buy a new TV. Let's go buy a new car. And it creates more demand. And when the supply can't meet that demand, price has to go up. And again, that's really the problem here. We've had asset prices going up, which is at least stocks, that made people feel better, and then ultimately that creates inflation. So they really have to generate a down move in the market and in crypto prices, unfortunately. And I know we don't want to hear that, but there's no other way. You can't have asset prices that make people richer going up, up, and up, because again, then why do people need to pull back on spending, which will then bring the inflation rate down?
Yeah, and we talk about asset prices. We look at, I was looking at this chart with my friend Brian the other day on Bitcoin, right? And I said, Brian, take a look at Bitcoin on the weekly chart. And for those of you who know Gareth's confirmation strategy, we never confirmed on Bitcoin, right? So we came up here, we tagged the previous all-time high. We had a green bar close, but then we closed below. And now, I think, I'm in the opinion that this is likely an epic bull trap on Bitcoin. We've had this amazing run, 300 or 400% bull trap, and now we get brought back down.
And I think the beauty of it too is that you have some very specific levels like this. Right off the bat, I'm seeing this right here. So this is again right around that 45, 40, give or take a little bit. So there'll be significant support there. There'll be right around 50 was where the spot ETFs. So there'll be bounces along the way. But in reality, you're right. I think that for the most part, this is very possibly a move to the upside that is now going to flush back down. And everyone was so. And by the way, a couple things that we have said is that number one, when you saw the altcoins and the meme coins and the scam coins, that's not the beginning of a bull market. That's the end of a bull market. And honestly, it was almost worse this time than in 2021. It was absolutely insane with what I was seeing on X and being pumped everywhere. And you just have to, as investors, always try to look for these signals. I know we want to believe that, we're going to make millions, but when you see the signals, they're telling you something. The other thing I'd like to point out, before we just go away, this is something fascinating to me. If you take the high of the first high in 2021 to the high of the second high in 2021, it's about 4,500 points higher, right? So 65 and change or 65 to about 69 and change. If you look at 69 and change and you add 45, so plus 4,500, you get basically 73,000 and let's say 500. And so it's just interesting to see that this high was 4,500 higher than this. This high is 4,500 more than that. It's just an interesting little confluence of synergies there. Very cool stuff.
No, so this is something we were talking about in the office earlier today. So this is ETH's chart, right? So Bitcoin broke all-time highs, but you see most of the alts haven't. If you look at Solana's chart, DOT, right, Ethereum, they all haven't broken out above their all-time highs. So there's a question there. Are the alts going to get a bid? And many of them are still very close to all-time lows. Honestly, in my opinion, I think that risk assets will follow the S&P, and this seems to be a fairly kind of neutral decision by the Fed, and I think the S&P just continues to trade in the way it has. It's overdone, right? We've had a 25, 27% run since the lows here in October, November timeframe, and now we're in a correction time frame, and I think we do break down. And as we do break down, I think the risk assets follow, like Bitcoin.
Yeah, I agree. And just turning back our attention here, guys, on an intraday basis to do a quick market update. I mean, basically, you got this ever so slight uptick on this decision, and then we've fallen right back into that same 10-minute range. So this is the 10-minute chart on the S&P 500, and you can see it's basically done almost nothing, which tells you that, and by the way, when the markets don't react to something, it tells you that they basically had priced it in already. So as of now, they priced in what the Fed said already. Now the question is, have they priced in what Jerome Powell is about to say at his press conference? And again, wouldn't that be something? I mean, again, with the market selling off yesterday heavily, and then today we're down a little bit, if he doesn't come out and say something positive, you got to think that this bearish pattern on the intraday is going to play out to the downside. So we'll watch here, and we have about 14 minutes until we get there. Now, Dr. B, let's talk about some of the movers today in the stock market.
Yeah.
I see you have Starbucks up there. You want to give us a little rundown
here?
Yeah,
so that's the other thing, right? We look at charts all day long. We're drawing trend lines. We're looking at the little nuances. We're understanding price action. And so if you look at Starbucks, it's down, I think, around 20% today. Mm-hmm. And just a couple months ago, when the S&P was still in an uptrend, we were seeing stocks that were getting beaten down bounce, right? But now we're really not seeing these bounces. Starbucks has been knocked down. This is a big company, great company, but it hasn't had a bounce, and it's down almost 20%.
And this is the hourly, so just so everyone understands. So that's why you see so few candles. And you only see so few candles here because yesterday it was so much higher that it's off the screen. I mean, if you flip over, can you flip over to the daily?
Yeah, let's go over the daily.
Yeah, so then you'll see the daily chart here. And again, what a drop on this chart. Incredible, incredible drop. So again, and I was just commenting earlier, is it's down 17.5% on the day. Like, I don't remember the last time this stock ever was down 17.5%. I mean, this is a stock that on earnings usually moves 5% or less.
Yeah.
I mean, so this is a huge thing. And I think I mentioned this in the game plan today, is that to me, Starbucks is like, not to offend anyone, but like it's like crack to some people, right?
Yeah.
I mean, like it's like if they don't have their Starbucks,
they can't function.
They can't function. They got to go get their Starbucks. And so if they're having trouble, what is that telling us about the consumer? And that's the bigger question then for an economic perspective.
And then go back and look at the credit card charts, look at the personal savings rates. Mm-hmm. You start to see there's some cracks in the economy.
Yeah, and that's something, again, you're not hearing on mainstream media, guys. Everything's rosy. Yeah. We're still heading for soft landings and no landings. But honestly, I don't see it. And I said this, by the way, 6 months ago, a year ago, I said this. I said that the Fed has literally never generated a soft or no landing scenario. They've always overdone it. They said it was transitory and we got this huge inflation spike that they weren't expecting. Then they went the opposite way, and now they're, it's a scenario where, and to be honest, I know they're supposed to be the best in the world at what they do, but they're still human, right? They still react emotionally and try to make things happen. And I just think ultimately we have to be prepared to be safe in our investments here.
Yeah. CVS is another company that had a huge fall today. Now CVS did get a little bit of a bid here. I'll go into the 10-minute chart. You can see that initially at the open we had a pretty big drop. But then it got a nice bid up. I mean, maybe around 5-6% on CVS. So for those of you who were taking this trade down here, it's a nice gain. But it's what we have to wait and see here what direction we go.
Yeah, I want to pop over. I just want to take a look at the bigger CVS chart here, and let's go to I'm going to actually go to the weekly. I had a couple lines that I think I talked about in the game plan today, and you can see that we did pierce. These are the same lines from this morning on the game plan. You can see number 1 right here and number 2 right here. These are going back to levels from 2020, the lows in 2020 right here and here. And so this is going to be a big level for CVS, and you can't deny that. CVS is like Walgreens, right? It's for those of us in the U.S. I'm not sure if these are all over the world, but WBA is obviously just like a sister company in that it's the same sort of thing. And then look at what this stock has done. I mean, it has been a brutal decliner consistently. And so, in all fairness, you're getting close to this lower end of the trend line, maybe some support there, maybe today and we'll flush and we get an opportunity for a quick swing trade. But it's been in a consistent kind of channel to the downside for a long, long time. And again, I don't know how many of you guys go into them, but occasionally I do. They're almost always empty. Like, honestly, you don't go in and you don't see lines. As opposed to Starbucks, I drive by the Starbucks, there's always a line. And we can see what Starbucks is seeing right now as well. So interesting on that. Another big one was AMD. AMD getting smoked on earnings today. You can see here, this drop right here, nice drop. It's not quite at my swing trade buy level just yet, but it's getting there. I have a level here and here. Let me change my my color so you guys can see this a little bit better. But right here to here, and then notice how these lows kind of kissed it. That tells me that right around this level, around 132, 133, to me, this is where I might get interested in a small swing trade on the long side. But until then, it's a no touch for me because, again, this is something that, in my opinion, these semis, the hype over AI, and like, listen, if you followed me for even a month, you know I've preached be careful. I've said this is just like the EV craze, this is just like the meme coin craze, this is just like the .com bubble, where these things went up too far, too fast. And it's not to say that AI won't change the world. It's going to change the world. I mean, Dr. B, you were a surgeon, you know. Eventually AI, don't be surprised if it actually probably does surgeries, right?
Yeah, oh, for sure.
So it's going to change the world,
for sure.
But it still doesn't replicate. Like, you still saw the internet change the world, but the stock still collapsed. In fact, one of the charts that, I didn't even realize this, but Corning, this is a play that did fiber optics back. Look at this chart. It's just kind of an example here of, this was the .com high, and look at that. It never even got close. I mean, Cisco Systems, another one. And again, wouldn't it be interesting if in 20 years from now we look back at NVIDIA and say, wow, remember those highs, and it never got, but here's your .com high, and this is where we are. At least this one's a little closer to those highs. Interestingly enough, Dr. B, look at this. All right, what kind of pattern do we see on this chart here? This is the monthly. Could be a head and shoulders,
It's
right?
like a head and shoulders, yeah.
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 So again, this is the monthly, so this is a big time frame, folks. So just be aware of that, is that bigger time frames, it takes a long time potentially to play out. But I mean, there's no denying if it continues to curl over, you have a neckline like this. And again, right here, if we break that, that would be really bad. And that could, again, if you see a recession, I mean, this is the other thing too, guys, and I'll kick it back to Dr. B in just a second, but we have a scenario where the markets and economists and analysts are not factoring in a recession in any form. So they're basically saying, yeah, stocks are expensive, but you know, hey, it's going to be okay because these stocks are going to grow into it. If we get a recession and earnings go down, think about what type of multiple these things will have to be reevaluated at. And it's like literally 25, 30, 40% drop in the stock market would not be a shock in that scenario. After all, in 2022, we were down about 27% on the S&P. What do you got over here?
Yeah, so you know, you were talking about AMD and head and shoulders patterns on Cisco, but you know, many of you, maybe some of you are sitting there, these patterns, they don't mean anything, you know, you can't make money from these. But look at this. Here's the left shoulder, here's the head, here's the right shoulder. If you shorted the break of this line here, you would have made 20% on AMD. And so, but here's on the other side, look at Tesla, right? Off of Tesla if you had bought down here at this level. Just a very simple line, right? Just geometry.
That's what
right?
it is.
So pretty amazing when you start to learn these things and start to see the patterns play out.
It is. It really is, guys. One other chart just to show you guys here is Pfizer's chart. I was actually very close to picking up a little of this going into earnings. In fact, this morning I got filled. I tried to buy, I think, 10 or 15,000 shares of this going into earnings this morning, pre-market. It was about 6:35 in the morning. They reported at 6:50, and I got filled 500 shares of it. Doesn't look like a big move on the chart because the chart's been so beaten down, but the line that I was watching was like, I mean, like, this is just a great trend line here. I want to show you guys this. So you can see, again, how you're taking this past line here, and we're here to here, right through this point, and then look at how it just bounces off of this each time. And so in my head, I say, okay, well, Pfizer's out of favor, no one likes it anymore, that means I like it more, right? So as soon as I think the majority of people are writing it off, I start to get more interested. Then I look at the chart and I see a trend line like this, and it's been beaten down, and I say, okay, this is interesting. So what ends up happening to Pfizer today on earnings? They announced earnings this morning. The stock ends up bouncing 6%. Now, 6% to some of us may not be a big deal. For Pfizer, that's a big bounce. That is a big bounce on Pfizer. You can see if I zoom in, nice green candle today. And by the way, that's in a down market. So just again, using technicals and psychology. Psychology is so important, you know, to not only as a trader, and Dr. B and I, we constantly in our trading room, we're going over like what we're feeling, what we're thinking, trying to control our emotions, be as robotic as possible. But it is so important to be a successful investor or trader to be able to avoid the emotion and just go with the charts. Let the charts guide us.
Yeah, it is. Speaking about the charts, you know, I mean, look at the S&P here, right? So if we have this, we know that this trend line, actually, let me zoom out for you and show you where that trend line came from. So this trend line was really helpful in us, calling some shots here on the trading floor. You can see that this high was from the dot-com highs. Okay, this is where the trend line started. This is the 2021 highs, and then we came up here on the S&P. And again, we talked about bull traps on Bitcoin, right? And I believe that this is very likely a bull trap on the S&P. So we pierced above that line, right? And then ripped back lower. And so if you zoom out here and you look at where the S&P is likely to fall, again, just based on trend lines, we saw how it worked with Tesla, okay? You can see here that the S&P has this great trend line coming from the COVID lows, all right, touching several times here. Very likely the S&P will be coming down into this area here, right around 450 on the S&P is what I'm thinking. And again, if you just shut off all the news, don't read all the articles, right? Keep an eye on things, of course, but don't let it cloud your judgment. The charts, what happens in the charts is actually the truth, right? It's what people bought and sold.
That's right.
And so if you can see here, this is very likely the next move higher. I find it very unlikely that the market continues higher with all the problems that we're seeing in the economy and inflation staying high. I think if inflation were around 2.3, 2.4, maybe 2%, you'd see the markets continue higher, but I just don't think that's going to happen.
Yeah, and speaking of trend lines, this is a trade that we actually took, Dr. B.
Yeah.
This is RCL, and I just want to show you guys the power of parallels, right? So we were watching this chart over the last week or so. Notice again this channel. You just continue to hammer along this lower line, then you go up here, then you come down here, and then you go up here. Once you have your second connector here, you can draw the parallel up, and notice how it hits here, and then sure enough, you can see the arrow right there. We shorted this, and I did this with Smart Money Stocks and ETFs members. We shorted it right up there, right against that line, and look at the pullback we've already gotten, a beautiful pullback. And it's again, it seems simple. It's probably not as simple as we make it because we've done this for so many years, but it is freeing to not have to guess, right? It's just like it's like this is the level, this is what I'm supposed to do. It doesn't guarantee us a win, but what it does is we know the odds, and the odds are 7.5 times out of 10 this is going to work. So if we do 10 trades like this, we're going to get 7.5 winners out of it, and that's really, again, the law of large numbers takes over at that point. Another one that I'll show you guys was CMG. Now this one I didn't get filled on. I'm so annoyed at myself, frankly, because I had an order out just a couple days ago, and I just didn't get filled, but it's exactly the same. So Chipotle, again, great company. I love their burritos, don't get me wrong, and their bowls, but I'm a trader. I look for things that are going to pull back, and I try to take advantage or bounce and the other way. And look at this again. I mean, just again, right there, and then look at that pullback right there. Look at the low end. It's freaking cool. I mean, this is the stuff that literally I will look at on the weekends on my laptop. I mean, how many times are we sitting on weekends and we're just going over charts, right?
Yeah, it's amazing.
So
it's
pretty
amazing.
Cool.
Can I make a confession?
Yes.
I actually got filled on that Chipotle, so I'm short on Chipotle right now. But I love their burritos.
We need like a thing, like a confessional, like they do on the reality shows.
Yeah.
It cuts away to you in like a room by yourself. Don't tell Gareth, but I got filled on Chipotle. Yeah, that's okay. He probably did like $100 million. That's why I didn't get filled on the trade.
Come on. So I just want to point out, parallels, and I talk about a lot of this, in some of my posts here at Verified Investing. But you have this parallel channel, right? So in general, parallels, so upsloping parallels are bearish, right? And downsloping parallels are bullish. I talk about this in my course in the 1 Minute Scalpel, and you can see here that we've had this very nice parallel, right? So you have this pivot, this pivot, this pivot, this pivot. Very clear parallel. We've had a breakdown, and now we're retracing, maybe potentially breaking back into the parallel. Now the markets are oversold here, so I'm not surprised. But in general, if you look at how the S&P is setting up here, you can see this uptrend, right, that we've had for months now, and now we're starting this downtrend, right? So there's a lot of buy the dippers out there, and I would say to you, okay, well, be careful because, you had let me just erase this here just to point this out, and this is so elementary but so important, and I've talked a lot about this, right? So you have these higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? But look at what happens here. Higher high, lower low, lower high, lower low, lower high, whoa, big lower low, and now a lower high. So this is, for me, a definite confirmed downtrend. We would have to break above, somewhere in these levels to reverse that, and maybe we do. Maybe we come up and form a big double top. Is Jerome Powell talking?
Yeah, he's just going to get
Okay.
started. Can we patch in the
Awesome.
audio?
Patching in now.
Okay. All right, so let's hear what he has to say, guys. I'm not hearing anything yet, but I'll just translate. Guys, we're going to keep
Past
rates.
year,
Everything
while the
seems to
labor
be
market
okay,
has
but we're going to
remained
monitor. Oh, I can actually
that's
read
very
the
good news.
transcript below.
But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain.
Maybe the
We are fully committed
Bringing
to returning
down
inflation
is
to
not
our
assured,
2%
and the path
goal.
is uncertain.
Restoring price stability is
committed to
essential to
2%.
achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged
Okay, you guys can hear
and to
it. Good,
continue
good.
to
All right.
reduce our securities holdings, though at a slower
put it up.
pace. Our restrictive stance of monetary policy has
check
been
it out
putting
and find
downward
out.
pressure on economic activity
Don't have a mouse
and
to
inflation,
look at here.
and the risks to achieving our
Restrictive
employment and inflation goals have
policy has
moved
been
toward
putting
better
downward
balance
pressure on
over
the
the past
economy.
year.
Bear
However,
with
in
me
recent
here.
months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6%
Okay, I'm
in
reading
the first
bottom.
quarter,
It's all good.
private domestic final purchases, which excludes inventory investment, government
So more
spending, and net
importantly, if we bring up
exports,
the S&P here,
and
let's see
usually
what
sends a
we're
clearer
doing here.
signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as
Interesting. So
high
it looks
interest
like-
rates
looks like
have weighed
initially,
on
folks, we
housing
saw an
and
up
equipment
move and then a little
investment.
reversal here.
Improving
Initially,
supply
the market's
conditions
getting
have
excited,
supported
but now
resilient
coming back in
demand
a little bit.
and the strong performance of the
So far,
U.S.
honestly,
economy
kind of
over
not
the
bad.
past year.
Yeah, it is. And that's why I think we just
The labor
keep in
market
that
remains
downtrend. We keep
relatively
trading
tight,
the way that
but
we're
supply
likely
and
to go.
demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years,
So in general,
and
I
the
wouldn't
continued
say
strong
necessarily
pace of
dovish
immigration.
or hawkish, somewhat neutral.
Nominal
from
wage
Fed,
growth has eased
right?
over the past year, and the jobs to
meaning
workers
interest
gap
rates
has narrowed.
unchanged.
But labor demand still
Yeah,
exceeds
and I think
the supply
so. So
of
again, we could
available
probably cut the
workers.
audio out. I think it's basically at this point we can just kind of focus on what the markets are reacting to. And I think at this point it's a slight sigh of relief because everyone was holding their breath going into this, like, oh my gosh, are they going to talk about raising rates? Are they going to talk about like being even more aggressive? And so far it hasn't been that. It's been basically, yes, we still want 2% inflation. They got to toe the line, right? But again, you can see just a little bit of an uptick, but honestly pretty muted at this point. Let's go to the U.S. 10-year. 10 years inching down a little bit, so markets are reversing. You know, there's an inverse relationship between the markets as well as the stocks, right? So the yield goes down, markets go up. That's what we usually see. So that's the normal reaction. The dollar, it is moving lower a little bit. So again, that's that little bit of like sigh of relief that we're getting right here as well. So again, just something to kind of keep an eye on there. And then really, if we flip through, I guess gold, let's do a check-in on gold. Gold inching a little higher, which makes sense. When the dollar declines, gold catches a little bit of a bid. I still am net thinking gold still has further downside, mind you. And by the way, don't forget, we have the non-farm payrolls on Friday. On Friday, that will be a big mover, plus Apple earnings tomorrow after the bell. That will be not so big for the U.S. dollar in the 10-year, but definitely for the stock market overall. But gold, again, little bit of a bounce here, nothing crazy on the gold chart. And then if we touch base, I just want to look at silver. I'm assuming silver's behaving the same way. Absolutely the same way. And then we go to Bitcoin, of course, guys. And Bitcoin it's still having a good bounce. I mean, it's not a bad bounce on Bitcoin, to be fair. We'll have to see, again, but look at Bitcoin here, guys. You're still kind of right in this zone right here. So Bitcoin needs to fight through this level. If it fights through this level, you start to get into kind of a little bit more of this zone right in here, somewhere in this vicinity. Around 60,000 now would be resistance on Bitcoin, somewhere in that vicinity there. But right now it's kind of struggling right there.
Yeah, and really, if you keep Bitcoin's chart, right, this is essentially a bear flag.
Yep.
Right? So down move, bear flag, likely to go lower.
Yeah, assuming it doesn't break and negate that by going up here. But yep, that's right. That's right at this point. And I think that just continues to kind of be a slight negative.
What's your take on the dollar, Gareth? So, we have the markets rolling over with the breakout on the DXY here. We can see this very clear wedge pattern that's broken out. Do you see the dollar going higher and the markets going lower, or how do you interpret this?
So this is where it becomes a battle of your mind versus reality of the chart. And the chart is usually what you're supposed to go with, right? So there's no doubt this is a breakout right here. And so this is a little bull flag right here on the weekly. You're on the weekly. So you probably do go higher on the dollar. In my head, I keep saying, yeah, but if eventually rates go down and they print more money, well, yeah, that's the bigger picture down the road. But just looking at it, and remember, folks, this is important, is the dollar trade. When we look at the Dixie chart, the DXY, we're not looking at the dollar and its buying power in terms of goods. We're looking at the dollar against a basket of currencies. So against the yen, against the yuan, against the euro. And in all fairness, the dollar remains the best house on a nasty block. Yes, we're not a big fan of what's going on here with the dollar and the Fed and everything like that, but it's still better than what's going on in a lot of other countries. Yeah. And therefore, the dollar tends to want to strengthen. So again, it's also very bullish for gold. Gold is very, very bullish as well.
Well, I know Japan's had some problems recently with their currency, right? Let's look at the dollar yen here. Let's take a look at that. So, geez, what a
look at the breakout here on this, and this is just remarkable. You had this very obvious wedge pattern like that, and you've broken out. Now, it was pretty amazing just the other night. It hit 160 to the T, 160. And then you saw like a $3-4 drop, which in currency terms is like an earthquake.
It's enormous.
It's huge. And so the thought, I don't think the Japanese central bank ever said that they intervened, but the thought is they did intervene there and push it back down. But in all fairness, it's already rallied back up. It was got as low as like 155, 156. We're already back in the 157s.
Sure.
And so remember, and this is what's scary too, guys. For Japan to be able to control their currency and strengthen it, they would have to sell U.S. debt. They're the biggest holder of U.S. debt. To sell U.S. debt, what is that going to do to interest rates here in the U.S.? It's going to push it up because you have a bigger supply of debt. You have U.S. debt on the markets. People have to find buyers, so they're going to have to offer a higher interest rate. And so really there's no good outcome here. It's like if they want to get their yen to be a little more stable and stronger, they're going to have to sell U.S. debt to do it. And they have so much U.S. debt that it could really cause a problem for interest rates here. So.
Yeah, I'm just taking a look at the monthly chart here on the other screen. If you look at the dollar yen,
look at that.
We're seeing rates we haven't seen, since
91, 92.
Yeah, or the 80s maybe. Yeah.
And then by the way, just looking at this, look at this. So if it does break out of this range here, you have this pivot low right up here, which would be your next expected resistance level, which it's hard to see exactly, but I would guess around 180, give or take.
Yep.
Man, by the way, we talk about black swan events, something that's unexpected. When you get a currency issue, a currency collapse or something, which can happen, that can be something that sends ripples through all currencies. And by the way, that would be a warning shot across the bow for the U.S. and all these other countries. Japan has 250% debt to GDP. Biggest by far of pretty much any major country. U.S. is at 130 to debt to GDP, which is still ridiculously high. But Japan, they've got some issues there. There's no doubt about it.
Just looking at Bitcoin, looks like it's breaking out here.
Oh yeah, look at this.
Yeah.
So we are starting to get a little bit move up in Bitcoin. We'll see if it's sustainable. Again, this is the 10-minute chart, so we'll have to watch and see on this front. I will admit, I was looking at MicroStrategies today. I was saying, all right, I'm going to pick up a little bit if it gets below the 1,000 even number. The low today was 1,010. So I did not get in. Now listen, could it go there tomorrow? Maybe. But the point is that was my level for today. I said if it breaks that level, it's a good technical level. And as of now, it's up about $75 off of the lows as Bitcoin moves up. But the idea is the psychological level of 1,000. Think about how many people, and this is how I think, guys. So I look at the chart, I find my supports, but then also I say to myself, well, how many people out there wish they had, when MicroStrategy was near 2,000, they said, man, I can't believe I missed the boat. If you get a three number handle like below 1,000 on it, think about the buyers that would probably want to scoop it up. And that was my thought process there as well from a psychological standpoint. Again, didn't get filled. That's real trading for you. That's what we do here at Verified Investing. We're real traders. We're real trading our real accounts over there. We have losses. We have gains. It's the real deal.
Yeah, I just want to point out Starbucks here. If you look at this chart, so this is the 10-minute chart. You had this trend line, this downsloping trend line, and we touched it perfectly. Put a little bottoming tail in here on the 10-minute, and now we're getting to move up. This might be the move for the day.
Yeah.
I think this is it.
I'm looking at this, and I see that bottoming tail too, and now the reversal. So that's pretty darn cool right there. And again, we're actually in this trade here, so I'm very happy to see this starting to make a little bit of a move to the upside. I did add with the live trading room. I told them rest just below the even number is where I would add, so that's good. And I love this trend line you can see right here. It's just a perfect trend line, and we'll see. But the way I think about it too is that Starbucks is still a stellar company. And yes, they had bad earnings, but does it justify a 18, 19% drop in a day? There's going to be some buyers that are going to coaxed in. I think there was a lot of funds. We were talking about this.
Fund selling.
Yes, and so one of the things we do is we watch what's called the level 2. We watch the price action in the chart. And today, every time it would bounce, it would get slammed down very quickly. Like every little bounce, boom. That's why you have so many of these like wicks on the top, is because there were big players that were dumping. Now you might say, isn't that bearish? Well, it is and it's not. It is because obviously big players are dumping, but a lot of these big players, these hedge funds, they're like, this doesn't fit our growth criteria anymore. So they don't care if it's going to bounce. Like for me as a trader, I'm looking for like a 5% bounce, 5, 10, maybe 10%. For them, they're like, we're done with it, we're moving on, dump your 5 million shares, and that's where you get this pressure. Once that abates, you usually get bigger moves to the upside, and so it'll be interesting to see if this finally has bottomed out.
Yeah, absolutely.
Yeah. Very cool.
Well,
I think that's good, guys. We'll go to center screen right here, and thank you guys for joining us. Somewhat of a lackluster Fed decision, but I think we covered a lot of really good chart analysis and education for you guys, which is really what Verified Investing is all about, guys. So thank you so much for tuning in. We'll do this next Fed decision, which is in a month or so, and we'll take you guys through. So thank you again, and come check out verifiedinvesting.com.
Thanks for coming.